Alright, let's talk about de-dollarization. Because what's happening right now isn't just serious, it's historic. Ever since the G7 froze Russian assets, the global financial landscape has been shifting in a way that can't be undone. That single act, done in lockstep with Europe, may have made diplomatic sense, but it sent a chilling message to the world about how the US wields its financial power. Biden made the call, but Trump didn't reverse course. In fact, his tariffs only deepened the fracture, showing just how aggressive the US has become in using economic influence as a weapon. Trade policy, consumer markets, financial infrastructure. What used to be pillars of trust are now tools of leverage, and that leverage comes with a cost. Foreign investors currently hold a staggering $19 trillion in US stocks, $7 trillion in government bonds, and $5 trillion in credit assets. That's over $30 trillion tied to America's financial system. In Treasuries alone, foreigners own about 30% of the market. This isn't just investment, it's the bloodstream of America's cheap borrowing. But with every escalation in trade tensions, that lifeblood thins. Trump's obsession with the trade deficit misses the bigger picture, the capital account surplus. That surplus has quietly enabled the US to borrow at near zero rates for decades. But the tide is turning, not just because central banks are backing off treasuries, but because something deeper is happening. Take Brazil. It's preparing to borrow using Panda bonds, denominated not in dollars but in Chinese yuan. That's a seismic shift. For decades, borrowing in US dollars has been the norm, because the dollar's status as the global reserve currency meant deep markets and low risk. Everyone wanted dollar-denominated assets, which translated into low borrowing costs. Brazil, for example, could traditionally take out dollar loans at favorable rates, backed by its strong export performance. A $74 billion trade surplus in 2024 alone, mostly in dollars. They could essentially mortgage tomorrow's earnings for today's investments. But the game has changed. Trump's tariffs have ripped up the playbook. The more aggressive US trade policy becomes, the more appealing it is for other countries to look beyond the dollar. That's not theoretical, it's already happening. Brazil recently issued a 10-year dollar bond at 6.73%, while comparable US treasuries were at 4.5%. If US yields climb, Brazil could be facing borrowing costs of 7% or 8%. Meanwhile, yuan-denominated Panda bonds are coming in at just 2%. That's a third of the cost. Yes, there's currency risk, but China controls the yuan's trading band. The dollar, on the other hand, is volatile. One day it drops, the next it spikes. US interest rates could rise, policies could flip, and dollar debt could quickly turn toxic. Here's where it gets even more strategic. Brazil runs a trade surplus with China, around 313 billion yuan, or 44 billion. As China cuts back on US food imports, Brazil is stepping in to fill the gap. That surplus is only going to grow. More UN earnings mean more room to borrow in yuan. The more Panda bonds Brazil issues, the more capital it pulls away from dollar markets. This creates a feedback loop Washington isn't prepared for. Trump's reshoring agenda may sound patriotic, but it carries a hidden cost. Global trade, the dollar's reserve status, and America's ability to finance its deficits cheaply. You can't have it all. You can't shield domestic industry, preserve reserve status, and maintain low borrowing costs. One of those has to give. Now consider China. For years, analysts have called for China to rebalance its economy. Well, that moment is here, but not the way people expected. China is facing deflation, not inflation. Consumer prices are forecast to rise just 0.3%. That opens the door for massive stimulus with minimal inflation risk. If US-China trade negotiations collapse, and that's becoming more likely, China won't wait around. The PBOC will act. It could slash reserve requirements, flood the system with liquidity, push yields lower, and start buying up its own debt. That would spark a boom in Panda bonds and draw even more capital away from US treasuries. Meanwhile, the US faces the opposite problem. Too much spending, too much borrowing, and now rising yields. Investors are getting nervous, not just about inflation, but about the dollar itself. If China starts importing more, and global investors pivot toward Chinese assets, US debt will face real competition. This isn't speculation, it's just the math. So what options does Washington have? Demand isn't bouncing back, not in the middle of a tariff war. The only lever left is supply. That means cutting government spending, and that's the logic behind proposals like Besson's bill. But this isn't just about fiscal discipline. It's about defending the dollar's very place in the global order. And just as all of this unfolds, a new headline drops. Japan is buying Russian oil again, even with sanctions still in place. The system is cracking. The signals are everywhere. De-dollarization isn't a distant threat. It's already happening. Cracks are spreading. Trump says he wants the war to end, but Europe's not backing down. The EU is doubling down. Von der Leyen pushing for a deeper cut, slashing the price cap on Russian oil from $60 to $45, and calling for a full permanent ban on Nord Stream 1 and 2. No more Russian gas. Not now, not ever. But this isn't just geopolitics. This is financial warfare. This is the disintegration of the old monetary world, the one where the US dollar stood unchallenged, unquestioned, and absolute. And if Washington doesn't wake up fast, the world's going to find out what happens when it decides to stop playing by America's rules. They're running the old playbook again. Strangle Putin, cut off his revenue, force a retreat. It's textbook, but something feels off. The timing is strange. Why now, when the global economy is already tottering? Why escalate, when Trump's 20% tariffs are about to hit and a trade war is back on the table? It's a move that defies economic sense. The consequences are not hard to see. You rip cheap Russian energy out of the global market, especially now, and what follows is a chain reaction. Production costs spike, prices climb, inflation bites harder. Layer tariffs on top, and suddenly exporting to the US becomes a fantasy. What you're left with is an economy gasping for air. And into that vacuum, someone else steps in. China watches, and waits, and absorbs. Every time the West turns its back on a pipeline, China reroutes it. Every sanction is an opportunity. Every embargo a gift. Putin doesn't lose, he adapts. He points the oil eastward, and Asia welcomes it. We've seen this before. It's not new. 3 years now, this dance has played out. But somehow Europe forgets. The memory resets every time the narrative shifts. Now the cracks in unity are showing, and they're not small. They're global. Japan just made its move. For the first time in 2 years, a Japanese refiner bought Russian oil. Quietly, deliberately. The drought is over. Why? Because the numbers don't lie. Sanctions don't erase economics. Price matters. Energy drives everything. Manufacturing, transport, exports, growth. And countries like Japan, like China, like Vietnam, they need energy. Constantly. In volume. Every single day. Remove affordable energy from that equation, and the whole structure begins to shudder. Japan didn't make this move out of rebellion. It was survival. They bought 600,000 barrels from a blacklisted tanker. On paper, it's defiance. In reality, it's precision. Because Japan has something unique. A waiver from the Biden administration. A quiet deal from a more pragmatic era in US foreign policy. That one decision changes everything. It gives Japan legal cover to do what it must. Buy Russian oil, even from ships under sanctions. And now here's the twist. If the EU wants to go all in on banning Russian energy, they might have to turn around and sanction Japan, one of their closest allies. That's what happens when sanctions become blunt force instruments. They swing wide. They cut deep. And in a fractured world, even allies start thinking for themselves. Japan's not doing this lightly. Over 80% of its energy is imported. For oil, it's over 90%. That's dependence on a knife's edge. No natural resources, just a massive, hungry industrial engine. But now that engine is slowing. Since February, Japanese exports have been weakening. In May, the first 20 days showed a drop, 3% down. For Japan, that's not a blip. That's an alarm bell. And June doesn't look better. Trump's steel tariffs are back. Over $1 billion in Japanese steel is exposed. If those tariffs stick, even just at 10%, Japan's industrial model will have to be rewritten. This isn't just about growth anymore. It's about stopping the hemorrhage. What's the fastest lever to pull? Input costs. And energy is the biggest one. But Japan isn't just competing with the US. It's locked in a price war with China. And China doesn't play fair. They play to win. Just last month, one of China's energy giants, VYD, cut prices 34%. That's not an anomaly. That's the third year in a row of deep, strategic discounting across China's economy. A full-blown economic war. And Japan can't fight that kind of war while paying premium energy prices. Their subsidies are drying up. Political support is fading. The appetite to fund expensive energy imports is gone. In that reality, buying Russian oil stops being risky. It becomes rational, necessary, obvious. So what does this mean for the rest of the world? It means Japan is the first, not the last. Others will follow. Quietly. Carefully. Russian oil isn't disappearing. It's just changing hands. The idea that sanctions can bleed out the Kremlin's economy? It's cracking. The price cap? It's a piece of paper in a geopolitical flood. This is the world now, fragmented, reactive, driven by desperation and survival, not ideals. The old alliances are shifting. Yesterday's rules are optional. Every nation is now playing solo. Hunger Games diplomacy. Chaos is the new normal. And in the middle of it, Japan has made its choice. Survival over obedience. So who's next? Will BRICS expand the RMB playbook and build a new financial highway outside Western control? Will other US allies strike quiet deals with Moscow while putting on a diplomatic show for the cameras? The world is tilting. Fast. And the so-called rules-based order? That may already be a ghost. What do you think? Will Japan go all in? Will the West double down or look the other way? Leave your thoughts. Stay alert. Stay sharp. This isn't just turbulence, it's a shift, and no one's at the wheel.